Welcome back to the channel, where we dive deep into crypto trends, blockchain technologies, and decentralized innovations. In today's episode, we're unraveling a major event in the Internet Computer Protocol ecosystem, what some are calling a money glitch. With 2025 entering its second half, massive shifts are underway across the Internet computer landscape. From AI rollouts to updated network mechanics, the pace of development is fast. And today, we're going to analyze an important anomaly that sent ripples across the ecosystem. Specifically, we'll break down what really happened with the ICP circulating supply, why it spiked, and why it didn't crash the price, a rare case in the world of crypto economics. Let's unpack the story, implications, and whether this was truly a glitch or something else entirely. This video is for informational and educational purposes only. It is not financial advice. Always do your own research and consult a professional before making any investment decisions. As we move through 2025, Internet Computer Protocol (ICP) is seeing expansive upgrades and shifts in strategy. Caffeine AI is scheduled for widespread deployment by mid-July, promising to revolutionize the concept of a self-writing internet. Users can describe a web app, platform, or tool in plain language, and Caffeine AI not only builds it, but deploys it directly on-chain, hosted by the Internet Computer. This alone is groundbreaking, but it's not the only advancement. We're also witnessing an overhaul in subnet infrastructure, the global node system powering the ICP blockchain. Alongside this, there is growing institutional interest in the protocol, with more organizations exploring its capabilities. However, today's story isn't about development or adoption. It's about numbers, specifically the unexpected surge in ICP's circulating supply and why it didn't lead to a price collapse. The Internet computer ecosystem has its own dashboard for analyzing protocol metrics, including node performance, cycle consumption, and crucially, tokenomics. Most of us routinely check these numbers for insights into future trends or anomalies. One metric in particular recently stood out: the total ICP supply. Historically, this number has shown slow, consistent growth due to normal inflationary processes. However, in mid-2025, something shifted dramatically. ICP's circulating supply jumped from roughly 485 million to 531 million in a short span, an increase of about 10%. That sudden increase sparked concern and confusion. Why would circulating supply leap so quickly in a decentralized ecosystem designed with cautious economic modeling? Was this a bug, a protocol error, or something more technical? Let's go deeper. Like Ethereum, the Internet computer has both inflationary and deflationary dynamics. On the inflation side, more tokens can be minted over time to reward validators or support ecosystem growth. On the deflation side, ICP gets burned when converted to cycles, units used to pay for on-chain computation and hosting. So, there's a push and pull. Increased network usage leads to more cycles, which burns ICP. Meanwhile, staking and vesting schedules introduce new coins over time. Ideally, these forces balance each other. But this 10% jump in circulating supply? That wasn't normal inflation. It was something else entirely, a change in how the supply is defined, not how many tokens actually exist. To understand what triggered this so-called glitch, we need to revisit a governance proposal made by the ICP community in 2023. At the time, there was ongoing debate about how to define circulating supply. Dfinity, the organization behind the protocol, originally chose a conservative definition that excluded some liquid ICP tokens under its control. These tokens weren't locked, but because they were held by Dfinity, they weren't counted as circulating. Critics argued this didn't reflect reality. Liquid tokens, regardless of holder, could technically be sold at any time. Thus, excluding them created a distorted view of true market liquidity. A proposal was submitted to update this definition and align it with industry norms, like those followed by Ethereum. When the vote was held, it passed easily, 64% in favor, less than 1% against. The update meant all liquid ICP, including those held by Dfinity, would now count as circulating. It's critical to understand, no new coins were minted. The total supply didn't change. What changed was the classification of some already existing coins. Imagine you have a locked vault with 100 coins. You unlock it, but don't spend anything. Those coins now count as in circulation, even if you don't use them. That's what happened here. So the spike in circulating supply wasn't a glitch in token economics. It was a shift in accounting logic. In many ecosystems, a sudden jump in circulating supply would cause panic selling and a price drop. If more tokens are available and demand stays flat, price should fall. But in this case, something unusual happened. Despite the increase of over 40 million coins to circulating supply, the price of ICP held steady. Even more interesting, that moment coincided with a price bottom. ICP stabilized around $5.20 and found support. Let's do some rough math. 40 million extra coins at $5.20 equals about $208 million added to market cap. That's a substantial valuation shift. But instead of crumbling, the market absorbed it. No mass exodus, no crash. This is why people are calling it a money glitch. In crypto, perception often shapes reality. The idea that a coin can see a major accounting change without a drop in value is almost unheard of. It indicates the market views the reclassification as legitimate and not inflationary. Moreover, it shows a level of investor maturity. Many stakeholders likely understood what was happening. There was no panic, only analysis and adjustment. Let's revisit the numbers. ICP launched with 470 million tokens in 2021. Today it sits at 535 million, an increase of 65 million over 4 years. That's about 16.25 million coins per year. At current prices, this adds $85 million annually to market supply. Is that a lot? Compared to XRP, which can inject billions monthly, not really. ICP's inflation is controlled and offset by cycle burning. Plus, staking data tells another story. Over 232 million ICP are currently locked in neurons, representing 44% of total supply. Notably, 146 million of these are staked for 8 years. That shows deep commitment by developers and high-level investors. Would you lock up your assets for almost a decade unless you were confident in the protocol? Now, factor in the AI component. Caffeine AI, ICP's smart deployment platform, could push cycle consumption way up. AI tools require enormous bandwidth and compute power, resources paid for with cycles. That means more ICP gets burned as usage scales, reducing net inflation. If ICP can maintain balanced burn-to-mint ratios while supporting next-gen AI applications, its tokenomics could strengthen even further. So is this a money glitch? Technically, no. Economically, yes. There was no protocol bug, no unplanned minting, no secret mint drop. But the optics? A sudden 10% increase in circulating supply without crashing price is rare, and in crypto, rarity often equals opportunity. To summarize, the increase was due to a governance-approved reclassification of tokens. The market absorbed the new supply without price collapse. Staking remains high, suggesting investor confidence. Network use, especially through AI, could fuel long-term burn mechanics. All signs suggest the internet computer is growing into its role as a serious player in decentralized infrastructure. This was not a bug. It was a bold economic evolution that the market quietly accepted. So, what do you think about ICP's current position? Are you bullish on its growth in AI and DeFi? Drop your thoughts in the comments below. If you found value in this deep dive, don't forget to hit that like button and subscribe for more breakdowns like this. Thanks for watching. Stay curious, stay cautious, and I'll catch you in the next one.